introduction to set the field for the panel discussion afterwards in terms of the investment market in Europe and how it's looking. And it is looking very well indeed. It seems that this will be a record year in terms of the volumes. It's already at 200 billion euros, and I think will probably approach 250 towards the year end. As you see, UK, France, Sweden, and many markets have outperformed 2014. So it seems that the markets are very liquid, and there is a lot of interest in not only core products but also value-add properties. If you look into the composition of the investor pool, it's diverse, and I think the diversity is growing. It's one of the features that has been prominent on the markets, particularly over the last 2 years. We've got an inflow, particularly from Asia Pac, more capital from the US, more capital from Canada. So it's definitely a very positive, distinctive feature of the market over the last 2 years, and in particular of 2015 to date. If we look at the sector composition, again, retail and office have, as usual, the lead. But what we would like to point to is the really good performance of the logistics and industrial sector at roughly 8%. If you look at the CEE region, we've had a record year in Poland last year, roughly 750 million euros in transactions, and this amounts to approximately 25% of the market. We feel that 2015 will be closer to 15%, but the main reason for it is the fact that there is just a limited availability of investment-grade product for sale amid a very robust demand. What we've seen across Europe is a number of substantial portfolio deals, one of them being Oak Tree's transaction in the UK for €500 million, and in absence of a substantial stock of property for sale, we feel that this will be sustained. But if the property pool was bigger, then probably the figures would also be higher, because there is a lot of demand for industrial at the moment. If I look at the summary of 2015 today, apart from the record volumes, what we are seeing, and I think this will impact the CEE region in particular, but what I hear is that it's a trend that will be prevailing across Europe, is the limited availability of product for sale, which will probably have a positive impact on pricing and further increase the competition. If I look at the composition of the CEE market, then Czech Republic has had a really good year at 2 billion euros in closed deals. Poland's share in the CEE, that's excluding Russia, has fallen from 40% to 30%, but the only reason for it is the lack of product for sale, because in all the transactions that we've led or we've participated in, we finally have a scenario of multiple bids for core properties, which also highlights the ever-growing demand among investors. What's also interesting, not only in the CEE region, but I think across Europe, is the demand for platform deals, and we've got the acquisition of by Cromwell. Obviously, TPG is highly involved. In Poland, the landmark transaction is the acquisition of Echo Investment by JV of PIMCO and Griffin, and Oak Tree in behind, which also highlights the confidence that investors such as PIMCO have in the market. It was their first acquisition in Poland, and it's a really strong positive signal for not only for Poland, but I think in general for the CEE market. And also liquidity. This is something that I'll touch on the following slide, but I think the trend is prevailing not only in Western Europe, but also in the CEE, because we see a lot of new capital coming in from places that we haven't seen activity previously, and I think also in Western Europe it's a distinctive feature if you look at the times pre-Lehman and if you look at the current times. When we do an in-house view of how 2016 is going to look like, we've got a few factors that we feel will play a major role in shaping the outlook for next year. One of that is really the globalization of real estate portfolios, and this is again the diversity of capital. For the first time, we see such volumes of money coming in from Canada, from pension funds, from Asia following the deregulation. And I think there is a lot of appetite to build up the presence globally, not only locally, which is a really good phenomenon for Europe and for CEE as well. The weight of capital, I think we are seeing a shift in interest, and a lot of the sovereign funds are turning into infrastructure and real estate, and they perceive it as a very attractive alternative asset class. And this means the funds like Japanese government fund or Norges, as soon as they start allocating capital into real estate, this translates into billions of euros of new equity injection. If I look at the Japanese government fund, this could be up to 65 billion euros of new equity to spend across global real estate markets. And this is also combined with the high M&A activity, because the next point is the local platforms. I think the investors, given the competition and diminishing product which is available to buy, they are not looking to build up the portfolios, but rather just go large, buy the whole platform. And we've seen quite a few of those in this year. You know, there are also present or prevailing on the logistics sector. We hear rumours of Macquarie trying to acquire CTP. So I think this trend will continue. I think that the next and final point is, and it's a positive outlook for Europe in general, is that Europe's as a real estate market still offers yield, attractive yield in comparison to Asia Pac. So I think the volumes will also turn towards our continent, and this is amid the low interest rate environment that could continue in the coming years. But if we look at risks, I mean, they are also visible, but I think if you look at the first point, the property bubble, the feedback we're getting is that it seems to be a lot more prudent, a lot more balanced than if you look at times pre-Lehman. There are no signs of irrational lending. There is a lot of equity being injected into deals. But I think probably the risk could be that, you know, given the shortage of product across Europe, it could mean that amid the appreciation of real estate prices, this is the only factor that could debalance the situation. If I look at the Grexit or Brexit, I mean, this has been discussed. Obviously, we've had to go through the Grexit discussions this year. The feedback we're getting on the UK's breakup from the EU is that they are looking for Prime Minister Cameron perhaps to go back to EU and negotiate a better terms and better package. And the feedback we are getting from investors at the moment is that it doesn't pose an immediate threat or immediate concern. Then we've got the China economic slowdown, which could have an impact on the global market amid the high regulation. As you know, the main macro indicators, there could be some distortion embedded into them. So I think the investors will look at the degree of uncertainty at that. And then we've got the rise of interest rates. I think we're on the brink of US rising the interest rates in the near future. UK could follow within the next 6 months, but in the Eurozone, we could still have the quantitative easing going forward. So this risk could be mitigated. And then we have the geopolitical risk, which, as you know, is prevalent, and this will not disappear. So every investment decision will have to take into context the fallout from Syria, Ukraine, and the global unease with regard to the situation in the Middle East. And obviously, low oil prices. This is a side factor, but given the decrease in prices, I think it could have also an impact on the strategies of the sovereign wealth funds with regard to the real estate strategies. So, in general, the outlook from our perspective is very positive. It seems that next year we'll see sustained liquidity, sustained diversity of investors amid a lot of competition for real estate product, and potentially prices which could still grow in selected areas. And I think the risks should not be dismissed, but to a degree that they can be managed, and I'm sure our panelists will dive into that in the next section of the presentation.